evening, everyone. Apologies for the delay. We'll be starting the session in next 10 minutes. Thank you. Thank you for joining us today. We'll be starting the session in next 10 minutes. Thank you. Thank you for joining us. Apologies for the delay. We'll be starting the session shortly. Good evening, everyone. Apologies for the delay. We'll be starting the session shortly. Thank you.
Greetings. Sorry for the slight delay to get started.
Yeah, so we're going to be starting now. Good evening, everyone, and thank you for joining us today. Welcome to the EY webcast Decoding the Union Budget 25-26. A panel of seasoned tax and industry experts will break down and analyze the announcements made by the Honorable Finance Minister today. I will now hand over the session to our moderator. Please welcome EY India National Tax Leader Sameer Gupta. Over to you, Sameer.
Greetings and a very warm welcome to EY's Budget Day session. Sorry for the slight delay in getting started. As we all know, this was a much awaited budget. We discussed this a few days back when we did a pre-budget webcast. And a lot of it was due to the July announcements by the Finance Minister around revamping the Tax Act and unveiling a new code, which we will cover as well in terms of what the roadmap for that is. But before that, let me get started with a few introductions. I'm very pleased to announce and present Amar Jyoti Barua. Amar, thank you for joining and making time. Amar is the CFO for the Mahindra & Mahindra Group. Prior to joining the Mahindra Group, Mr. Barua was finance leader for the OFSC segment of Baker Hughes. He's also worked with General Electric across diverse businesses for 18 years including as CFO for the power conversion business, the mining business, and many other mission critical roles. Welcome, Amar. We have with us Dr. D.K. Srivastava. Dr. Srivastava is the Chief Policy Advisor at EY India. He is a noted economist, and he was also a member of the advisory committee to the 15th Finance Commission. My partner colleagues, Ganesh Raj, National Business Tax Services Leader, and we have Uday Pimprikar, our Indirect Tax Services Leader. So friends, let's start with a little backdrop to the budget. And if you see as a backdrop, the global economy, and if I were to just spend a minute on that, continue to show resilient growth, which is hovering at about 3.3%, and that's the estimate even for the 2 years ahead. Even while this is true, and I know it's not lost on anyone, that the headwinds at the global level continue. Geopolitical issues continue to persist. Supply chain disruptions are affecting trade flows. And electoral mandates in several of the major economies are bringing about policy uncertainties. In the backdrop of all of that, India continues to be a growth leader. It's the fastest growing large economy in the world. And even though the GDP growth for FY25 was tempered downwards, India has continued to be on the growth track. Several factors do come in play when one analyzes, and we will go into this in greater detail in Dr. Srivastava's session as to why the GDP had to be tempered downwards. But one of the factors is the contraction in the capital expenditure. From a fiscal consolidation objectives point of view, again, for the immediate terms, FY25 and 26, the glide path is likely to be maintained. But in the medium term, going forward, FY27, this may need to be tempered, especially given the implementation of the 8th Pay Commission, as and when these are rolled out. So on the back of that, the expectation was that the finance minister would really look at domestic drivers for growth. And let's see how all of that came about. Moving to the next slide. This was presented yesterday, the economic survey. Again, a lot of data was presented, but 2 or 3 points. The construction and the services sector was called out as having contributed to that GDP growth. And even though the rupee is under pressure, when one looks at the forex reserves, we do have a 11-month forward cover available to us. Several points were called out by the ECO survey. A lot of them revolved from a focus area around deregulation, as well as ease of doing business and bringing about structural reforms. Manufacturing, even though there has been a focus on manufacturing, there was an acknowledgement that this still contributes only to 2.8% of global GDP. And therefore, a lot of mention in the economic survey on the need to encourage R&D expenditures, skilling, as well as supply chain. Couple of focus areas from an energy transition point of view, energy security point of view, but a big call out was there from an AI perspective, and really to look at how India can harness the opportunities on AI, especially given its young and tech savvy workforce. From an overall perspective, FY26, a very realistic goal of 6.3 to 6.8% for GDP growth. I think the key area that one will really need to focus on is how will we step up to the 8% GDP growth, which we really require for the next 2 decades for Viksit Bharat. So with that background, perhaps, and before we get into the actual presentations and the speech and the coverage of the proposals, I would like to bring in Amar to share his overall comments on what he heard in the budget. And Amar, if you can please comment on that.
Great, Sameer. First of all, thank you for having me on this. Really a pleasure to be talking to all of you. See, overall, let me start with how we have been, what is it that we as a company have been looking forward to as we think about this budget? See, there is plenty of growth in India to be tapped. That goes without saying. I think as you look across sectors, there are sectors which are growing at double digits. There are sectors which are a little less than that, but there is plenty of growth which we aren't necessarily seeing in the rest of the world. So India actually is really a standout from that standpoint. Now, that does mean that there is some unevenness, and that unevenness has manifested itself in both the urban outlook. There was a lot of noise around it in the third quarter, even going into the second quarter. And then there is some unevenness as you look at specific sectors, like for example, logistics did indicate that there is a general manufacturing slowdown in the third quarter as well. So we were looking forward in this budget to see how the finance minister is thinking about growth and sustaining the growth momentum that India has. And I think she's tried to do two things: really drive a consumption-led growth, which is where the middle class and this increase in income tax exemption is going to be incredibly helpful. And then the second is just there are some real challenges in India around the ease of doing business. And I think a lot of her tenor was around the ease of doing business. And I think that tone will help set the tone for the rest of the next 2-3 years. And then the third thing we really were looking forward to was something around agriculture. The last couple of years have been very uneven for the rural economy, and we were looking forward to that as well. And I think that, again, the finance minister put a lot of emphasis on. So overall, I would say that everything we're looking forward to, we heard during this budget, but we'll go deeper into it as we get through this conversation.
So thank you for that, Amar. And I'm sure as we delve into greater details, we will ask you to come with more insights on what you heard. So thank you for that. Let's move to Dr. Srivastava's part, where I'm like every year, I hope he will lucidly explain to us all of the number game over here. Dr. Srivastava, over to you.
Thank you, Sameer. Thank you very much. Greetings to all the participants. The background to the budget is, in fact, in terms of the growth performance of the Indian economy in the context of the global economy. Now, as we start looking at a recent history of India's growth performance, something very striking appears, which is that the momentum is downwards. If you look at the chart on the left-hand side, after the peak performances in FY22, which we pass off as base effects, starting from FY23 onwards, both the real GDP growth and the nominal GDP growth are trending downwards. And so much so that, in fact, it is the nominal GDP growth which is critical for the fiscal aggregates of the economy. It is now in FY25, according to the first advanced estimates, estimated at 9.7%, which is lower than what the budget had assumed in July last year at 10.5%. On the real side, it is now, according to the first advanced estimates, 6.4%, which is lower again than the economic survey estimates, to which we shall turn to in a moment. But for FY25, if we analyze the reasons as to this slowing down of growth, as it were, slight deceleration, on the demand side, which is the top table on the right-hand side, it is the investment, which is more technically called as gross fixed capital formation, the third row there. It has fallen from 9%, the growth rate, from 9% to 6%, from FY24 level to FY25 level. So that is the main reason. All the other demand components appear to be robust. As far as exports and imports are concerned, we should look at the net contribution of exports, and that is also positive at 1.7%. That is the last but one row, the seventh row in that table. So on the demand side, it is just one major thing that the budget needed to focus on, that is to say, gross fixed capital formation or investment. Now that investment comes from both government and the corporate sector, and we shall go into that in terms of what is contained in the budget. Now on the output side, except for agriculture and public services, that is first row on the bottom table and the last row on the bottom table, public services at 9.1 and agriculture at 3.8. Now 3.8 can be considered as a robust performance because average long-term growth in agriculture ranges between 2.5 to 3.5%. It is the non-agriculture, non-public services sector that is the one that has languished. And particularly, it is the manufacturing which has shown a fall from 9.9% in FY23 to to 5.3%. I think that should be FY25. So now we go to the next slide in order to look at what the economic survey signaled and what the first advanced estimates are indicating. The economic survey gives a range. Last year also it gave a range of 6.5 to 7% for real growth, and the midpoint of that is 6.75. For FY26, it gave a range of 6.3 to 6.8, and the midpoint of that is 6.55. So there is a downward reduction in economic surveys estimates. General understanding is that actually the economy is headed towards the lower limit of this range. In fact, the first advanced estimates for FY25 had indicated 6.4% only. And IMF estimates are also trending downwards. It was 7% FY25 and 6.5% FY26. But what is crucial is actually it is the nominal GDP growth. Now here we can take two perspectives are there. If we go by the first advanced estimates given by NSO, then that is 9.7%. The budget has that is 9.7% in FY25. The budget has estimated a 10.1% growth. Last year they had estimated 10.5 and the turnout was 9.7. So they had overestimated last year. Hopefully it is more realistic this year now that already they have revised it downwards. In spite of this slowdown in the real GDP growth, we find that we are still doing quite all right in the global context because India's growth rate at 6.5% being projected by the IMF. It is nearly double of the global growth rate. So we have to therefore look not only in terms of the growth potential of FY26, but also in the medium term going forward, whether we can maintain a growth rate on average of about 6.5% or so. Of course, the survey had called for a much higher real GDP growth rate, but we can come to that as we go along. So these are the two basic highlights as far as the economic background is concerned. Now, from here on, let us start moving into the fiscal side of the equation. And at first, we look at the performance of the tax revenues, because tax revenues constitute the core for financing government's expenditure, which actually leads to government demand. So it is the aggregate demand that we are after. But that is going to be financed primarily by tax revenues. And there is a concern there that I noticed, which is that if you look at the last block of buoyancy, tax buoyancy, which is percentage change in tax revenue relative to percentage change in nominal GDP growth, you find that gross taxes have trended downwards after FY24. So buoyancy came down from 1.4 to 1.15, and now they are budgeted to at only 1.07. And this, of course, it can be decomposed into the buoyancy of direct and indirect taxes, and within direct taxes, we have the corporate income tax and the personal income tax. Now here again, you see, in terms of the personal income tax, there is a downward trend, although it has been performing much better than everything else. But the buoyancy is downwards, and that is why there is a cause of concern, which is here. The budget has actually indicated that the corporate income tax would show in FY26 a higher buoyancy as compared to what is being expected in terms of the FY25 revised estimates. If that transpires, that would actually absorb some of the revenue foregone through the personal income tax rationalizations and the increase in the disposable incomes that have been announced in the current budget. But as far as the tax GDP ratio is concerned, FY25 to FY26, we notice a very marginal increase in the contribution of gross taxes relative to GDP, moving up from 11.9 to 12%. The incremental change actually indicates the kind of constraint that the finance minister faces when there is an attempt now to balance the budget in terms of achieving the target of the fiscal consolidation as we go along. So now from here on, we look at the broad aggregates and bring in other elements of the budgetary balance account. So we move to the next slide. And here you see the gross tax revenues are contributing 12% of GDP. But after share of the states has been taken off, then what is left with the central government is net tax revenues at 7.9%. And to that, we add non-tax revenues and non-debt capital receipts to arrive at total non-debt receipts, which is 9.8%. That is the revenue side. And then to that, we add the borrowing side, what we otherwise call fiscal deficit. And 9.8 and 4.4 gives us the size of the available resources, which is going to finance the total expenditure. And that is 14.2%. So here we should pause for a moment and look at what is the change that is being signaled. FY25 revised estimates, that size of total expenditure relative to GDP was 14.6%. That has been driven down to 14.2%. In general, public finance literature, that would be called as a contractionary budget. Unless this gets neutralized by improvement in the quality of spending. Now, there are some signs that actually the quality of spending is being signaled to improve. In fact, the share of revenue expenditure has gone down from 11.4 to 11%, whereas the share of capital expenditure has remained at the same level at 3.1%. Therefore, in the composition of expenditure, we expect, therefore, that the share of capital expenditure in total expenditure is improving. And therefore, the quality of expenditure is improving. And that would partially offset some of the impact of the contractionary nature of the macro impact of the budget. So from here, if we move to the structure of expenditure, then we find that over a medium term, there has been a very significant impact of fiscal reforms. So let me say what is the appropriate or the right movement and what is the movement that with which we should be concerned. First of all, if you look in the lower block, major subsidies as percentage of total expenditure have been coming down. That is the one that reforms, that is the part of revenue expenditure. When it is driven down, then fiscal space is created for capital expenditure. And that is the reason why capital expenditure initially increased in FY24 and FY25. But now capital outlay on non-defense has gone down and capital outlay on defense has gone up. Usually, non-defense capital expenditure is associated with a higher multiplier, and defense expenditures also have positive multipliers, but they are associated with lower multipliers. So as far as the capital expenditure side is concerned, we notice that actually it is stagnant at 3.1% of GDP. And the structure of that expenditure is slightly moving away from non-defense, that is to say expenditures with lower multipliers. What is really of concern is the movement of interest payments. Now, interest payments are increasing by the year, and they are now accounting for 1/4 of the overall government expenditure at 25.2% in the budget. The way the deficit, fiscal deficit and government debt is going to be handled will determine this path. And another non-developmental expenditure is pension, which is shown to fall here from 5.8% to 5.5%. But we have to recognize that just in the next year, FY27, pension expenditures along with salary expenditures will be increased substantially. And therefore, what will happen as far as pension and salary expenditures are concerned, along with interest payments, both non-developmental expenditures would progressively put greater pressure on the policymakers. Now we come to the crux of how interest payments are determined. And here, if we go to the next slide, please, I look at the path of the fiscal deficit relative to GDP after the Indian economy got hit by COVID. So you see, it took 2 years for the fiscal deficit to shoot up from 3.4% to 9.2%. That's just Government of India. And then that is the upward path. It took 2 years. Look at the downward paths. It's so asymmetric that after reaching a projection up to FY28, and if we go beyond, because the budget has given a perspective going up to 3031 as to what will happen to government debt GDP ratio. This is where a major announcement came. In fact, that announcement came last year when the finance minister said that now onwards they are going to focus on only an annual reduction in the debt GDP ratio, without indicating as to what would be the corresponding path for the fiscal deficit to GDP ratio. We looked at the documents attached with the budget as to the scenarios that they have constructed regarding the path of the debt GDP ratios. And they have a moderate scenario and a mild scenario, as also a more serious scenario, severe scenario. And in all these cases, actually, the debt GDP ratio falls just about 50 to 52% in that range by the year 3031. And that implies that fiscal deficit would be in the range of about 4.4 to 4.2% even by 3031. Once we also accommodate the burden that will ensue from these increased salary and pension payments. Therefore, the path is so asymmetric in terms of fiscal consolidation. It has taken 2 years to go up, and it has taken more than 10 to 12 years to go down, but there is no likelihood of reaching back a 3.4% in the medium term. I think we can't see that path anymore. This is a matter of serious concern, because we cannot ignore the impact of maintaining high level of debt and interest payments. It's going to be self-defeating in the end, because the space that is left for primary expenditure would keep getting squeezed, and therefore we'll have to borrow more and more in order to sustain a level of government expenditures. So there is going to be a major challenge as far as the medium to long term is concerned, which has implications for Viksit Bharat. I would just spend one more minute on the major thrust of the welfare schemes, social sector schemes that the government has come forward. And you will notice that they are welfare improving schemes where allocations have been increased, except for one, which is crop insurance scheme. But the most favored social sector scheme is Jal Jeevan Mission, which is, I think, quite all right in terms of the prioritization. Last slide actually indicates the profile of major subsidies. You see here, government has done very well in the medium term. Next slide, please. Yes. And it is going downwards, the share of major subsidies as percentage of nominal GDP. This is the only redeeming feature in the sense that medium-term reforms have yielded results and created fiscal space for the Indian economy. So I'll stop here, Sameer, and we'll come back to the questions as we go along.
Well, thank you, Dr. Srivastava. I think there's a lot of messages that you've distilled in that. I'm sure there will be some questions as well. So we'll come back to that. Ganesh, if you can cover, the key policy announcements laid out by the Finance Minister.
Yeah, thanks, Sameer. Good evening to all. So some policy announcement. Of course, there were very many, but some of these were really the thrust areas. The first one being on infrastructure heading. So there is a nominal increase in the capex target as compared to the last year from 11.11 to 11.21. And most importantly, I think there is a 50-year interest-free loan allocation of 1.5 lakh crore to the states, not only for the capex, but also for incentive for reforms, which have been allocated. The third is the last year, this was announced Urban Challenge Fund of 1 lakh crore, basically for the cities as a growth hubs and creating a redevelopment plan of the cities and water and sanitation. And this year they have allocated for the year 25-26, 10,000 crores. The second broad thrust in this policy announcement was an MSME. First, they have changed the reclassification in terms of the definition of micro, small and medium, both in terms of the investment and turnover. For those of you who are interested, just quick roll call I will make that micro currently investment is 1 crore and turnover is 5 crore. They have changed for micro the investment to 2.5 crore from 1 and 10 crore on turnover from 5. Similarly, in small, earlier the current investment was 10, turnover was 50 crore. They have changed the investment to 25 crore and turnover to 100 crore. And finally, the medium enterprises, current is 50 crore investment and 250 crore of turnover. 50 of investment has become 125 and the turnover has become 500. I mean, all these things, the relevance and importance to this reclassification is much of the supports and incentive which are given to the three segments of micro, small and medium is basically based on the criteria of investments and turnover. So I think it was a long due and they have done it. Then similarly, 10,000 crore additional contribution by the government into fund of funds for startups, just to again augment the startup ecosystem. And 10 lakh credit cards, number of 10 lakh credit cards to be issued to 5 lakh with a 5 lakh limit per card for the micro enterprises. Two sectors which are very export potential all historically in India has been given focus. First is on the footwear and leather sector. They are going to create a capacity for component manufacturing both for non-leather and the leather footwear. And they are expecting that the scheme will have an employment of around 20 lakh persons and generate a turnover of 4 lakh crores and export potential of 1.1 lakh crores. The second area which for the first time they have been looking is on the measure of toy sector. They want to create a cluster and skills for manufacture of high quality, unique, sustainable toys and to make India represent as Make in India brand for these toys. These were some of the key policy announcements surrounding the MSME. The third area is the clean energy. And in the clean energy, of course, they are exploring research and development in small modular reactors, as we call SMR. And they want by 2033 that 5 of such SMRs indigenously developed will be placed from a clean energy perspective. Similarly, clean and tech manufacturing support to improve ecosystem and domestic value addition for various solar PV cells, EV batteries, electrolyzers, turbines, and various other things. The third area on policy announcement was more in terms of investment in people. Last budget in July, the FM had announced of building of 5 national COE Center of Excellence for skill development with the help of the global expertise and the partnership with the youths for ensuring that make for India and made in India for manufacturing. This will essentially cover train the trainers, skill certifications, and periodic reviews of the skill development being imparted to these skill centers. The second area where they have allocated is the artificial intelligence. They are going to set up a center for excellence in AI for education purposes, where they have allocated 500 crores. And the last is science and engineering. They are going to increase the capacity of both in IITs and medical schools in India by the next 5 years, and they have given some target. The next one is export. Like we have this ULIP, they have set up a digital public infrastructure, which is called as Bharat Trade Net, which essentially is going to be a solution for both trade documentation and financing solution. This will also be complementary to the ULIP. This will be aligned with the international best practices. So these are essentially to support and help the export sectors. And the last one in the this one is GCC. They are going to set up some sort of a guidance to the states for promoting GCC and tier 2 cities wherever there is an enhancement or availability of talent, and to create infrastructure and create a building bylaws, reforms and mechanism for industry with the industry collaboration. So that much of the tier 2 cities, they want to capture and tap the potential of the talent by creating GCCs in those areas. So those were on export. Next, Sameer, maybe you can talk on financial sector reform.
Yeah, thanks, Ganesh. So very quickly on the financial services side, on insurance, there was an announcement to increase the limit to 100%. Right now, there are 2 insurance companies which are at 74%. And the other mention which was there was that the current guardrails on FDI will be reviewed and simplified. There are a number of provisions which are there on management and governance of these companies where there is FDI, and there will be a separate insurance bill which will look at all of that. The other is around the central KYC registry, which is called CERSAI. There is a plan on CERSAI 2.0 to be launched, and this is really going to come up with enhanced functionalities, both on the ability of the borrowers in terms of how they are able to provide the information, as well as for the banks, mutual funds, and other participants as to their participating in the entire CKYC process. So a lot of functionalities are supposed to be revamped in that process. And lastly, on the entire pension product space, there is a lot of work that is now needing to come in to give a fillip to the pension industry. And there was an announcement that there will be a forum for coordination of this, and the process will be institutionalized. So those were the overall financial services sector related announcements. Ganesh, we can come to the income tax related proposals now.
Yes, yes. So from a big picture perspective on this income tax, I think there's no brainer that the biggest boost for the consumption, whereby they have given a very, very big unexpected relief, I would say, is on the personal tax rates. And number 2, everybody was waiting and watching as to what happens to the fate of the new income tax bill, which the finance minister announced that it is going to be tabled in the next week in the parliament. And that law is going to be more in terms of the language simplification, and as well as the reduction both in the number of sections and number of pages of the current income tax law. So we have to wait and watch as and when it is introduced as to how it goes. The third were to make IFC and GIFT City more attractive, more provisions have been introduced, which we will see. And finally, of course, there were a number of small and big one on ease of doing business, more from a taxation perspective, like rationalization of TDS and TCS rate, and also decriminalization of some of the provisions on TCS in particular, which were missed out in the last July budget. So those were some of the very big ticket items, and we will quickly go through. So the first one is the concessional tax regime, which is otherwise called as the new tax regime. As you know, that parallelly the old tax regime with deductions and exemptions are still in practice. But I think the changes which have been brought out is in the slab of the new tax regime, which is the concessional tax regime. And up to 3 lakhs, earlier it used to be nil, now it has been made to 4. Then the next slab moves from 4 to 8, 5%, 8 to 12, 10%, 12 to 16, 15%, 16 to 20, 20, 20 to 24, 25, and 25. So basically, there are around 7 slabs now, including the 0-1, which used to be 6 earlier. And surcharge, of course, there are no changes significantly. It continues to be the same. But the big announcement is that they have changed the, what should I say, the rebate, and because of which income or the salary income or the income up to 12 lakhs plus 75,000 for this one standard deduction, there is no income tax. So we have just populated a table that if the taxable income of an individual is 12 lakhs, then basically there is no income tax and the saving is 83,200. And then up to 15 lakhs, then the saving goes to 36,400, 24 lakhs, 1 lakh 14, and 60 lakhs, 1 lakh 25, and 1.5, 131, and 2.5 crores is 143. I think the 2 key features here that even the highest slab, these relaxation will be available based on the slab recalibration, and also essentially they are twinked with the rebates, and hence the earlier it used to be with rebate up to 7 lakhs, no income tax. Now it has moved from 7 lakhs to 12 lakhs with the tweaking of the rebate up to up to 12 lakhs, no income tax on that. This is the big thing I would say that nobody was expecting. Everybody thought that 7 will move to 8 or 10 max, but I think this is the big thing which we have given. And I don't know, I think when I was going through the revenue foregone statement, this one was showing that the revenue foregone because of this 12 lakhs limit is essentially some 1 lakh crore. But we have to see the detail how it is sort of broken up. Some of the other changes was that under the income from house property, earlier only one house property self-occupied was allowed as nil, except where because of your employment or profession, if you have to stay in a different city and you have a second house, then those were allowed as 2 houses self-occupied as nil income. But now they have removed those conditions. So essentially anybody who up to 2 self-occupied houses will be subject to nil, no taxes on that. Similarly, calculation of perquisites, particularly for medical treatment, there was earlier provision which was introduced some 30 years back that if the salary income of an employee is 50,000 and if that employee has to go travel abroad and which is being paid by the employer for medical treatment of himself or his family members, then up to 2 lakhs if the medical bill comes, then there will not be any perquisite calculated. But the memorandum clearly says that these were limits were prescribed 20-30 years back. So they are going to prescribe new revised salary limits as to in what situations the perquisites will be non-taxable or will not be treated as perquisite, particularly for a medical treatment of the employee or family members. The third one is on LRS, which is the TCS, which is applicable. They have increased the threshold, which earlier used to be 7 lakhs to 10 lakhs on foreign remittances. And the TCS is not applicable for any remittance which is done to any for education purposes, provided the loan is obtained from any specified financial institution for the education purposes. Next, please. This is one of the very big thing to avoid the litigation, and I'll give you a 2-line context to it. That in the last 1 year, we have seen that India is focusing more on semiconductor chip development and various other electronic manufacturing areas, and for which there are countries outside India who are very good in it, and they are coming and helping us to set up this industry and support us till we go live on the manufacture. But always there was an issue that what happens that tomorrow these people who come to help and set up this industry will face a problem on permanent establishment, transfer pricing, and various other tax litigation which in the past has happened. So I think they have come out with that any payment which is made by the resident company to the foreign company which is coming and helping us to support in setting up the technology for electronics manufacturing facility, then of that 25% of the revenue will be deemed to be the income, and on that 35% rate. So basically it effectively it comes to around 9.8%. So once you pay that foreign company pays that 9.8%, there is no question or any issue of allegation of permanent establishment, transfer pricing, or any such thing. And one of the very good thing they have done, like unlike the other deemed profit taxation sections which is there in the law, that they generally exclude FTS and other P scenario. But they have not said anything like this. So regardless of whether it is the payment is in nature of FTS or regardless of whether it is a P, still whatever payment is made, 25% is deemed as business income. So this is really a welcome feature because in the next few years we will see several foreign companies helping us in setting up, particularly in the electronic manufacturing facilities. The next one is the tonnage tax scheme. Currently, this tonnage tax scheme is applicable only to the ocean-going ships registered on the Merchant Shipping Act, which are Indian flagged. Now, in order to boost the inland water transportation, they have also extended this tonnage tax scheme for the inland vessel registered under the Indian Vessel Act. So that is an extension so that it makes the life easy for the inland water transportation. Next. Expanding the definition of capital asset for including security by the Category 1 and Category 2 AIF in accordance with the SEBI regulation, certainty that it will be taxed as capital gain and not business income, because there used to be a few cases and interpretation that whether those AIF where they are investing in security, some of them used to take the position of business income. Although generally it was very clear that this will be taxed in the character of capital gain. Just to make it clear, they have said that it will not be as business income but as capital gain. To welcome change in the sovereign wealth fund and the pension fund, all the sovereign fund and pension fund who get the tax exemption on their investment to the infrastructure facilities was expiring on this 31st March 25. And India does need these funds from sovereign wealth funds and pension funds for infrastructure. So they have extended it by 5 years up to 31st March 2030. This is also good that instead of just extending by a year or two, they have given a very good leeway of 20-35 years. Currently, in the last year, there was a reorganization of the entire capital gains. In that, one of the area was that all unlisted debenture security were will be treated as a short-term capital gain. Now it is clarified because they missed out that what happens to the sovereign wealth fund and pension funds who invest in this unlisted debt security. Now they are clarified that even those people who invest in the unlisted debt security will be exempt from capital gain tax, short-term capital gain tax. Of course, all these provisions are applicable from assessment year 25-26, unless otherwise stated. Similarly, the debt instrument, unlisted debt security, they have extended it that which was again expiring like the equity one in 2025 to March 2030. Capital gains for API, long-term capital gain rates for API, which was again missed during the last year reorganization of capital gains chapter, which was still coming as 10. Now, in order to bring a parity, they have made it 12.5%, which is the rate for all long-term capital gains, including on securities. Harmonization of significant economic presence. This is a good thing what they have done, that this is significant economic presence is a part of the business connection chapter which we have under the domestic tax law. The way they carved out a few years back the significant economic presence, they said any sale of goods which is sourced from India for the purpose of export, is also subject to significant economic presence and thereby subject to tax. To harmonize this business connection and ACP, because business connection carved out very clearly that if a foreign company or a person sources goods from India through its agent, and that is essentially for export from India, then that will not be treated as a business connection. So in order to bring a parity between ACP, which did not have this provision, they have brought that activities of a non-resident which are confined to purchase of goods in India for the purpose of export shall not constitute ACP in India. So this is a very welcome clarification which is there. Otherwise, a disconnect between business connection and ACP was there. Startup, of course, the startup 3 out of 10 years, 100% reduction, which is available for startups. It's a profit-linked tax exemption was expiring on 31st March 25. They've extended up to 31st March 2030 to really give a boost to the startups. Section 72A and AA, rationalization of carry forward of losses in case of amalgamation. The key point here is that once company X merges with Y, company Y will carry forward any losses accumulated of company A for the period of 8 years. Now, in order to plug that, what they have come out is that, and this 8 years, they used to get a new life in the hands of Y in my example. So again, it will sort of continue, and tomorrow after 8 years, let us say the Y gets merged with Z, another 8 years it will go on. So this will keep continuing like this. In order to plug this, what they have done that such losses will be available only 8 years to be computed from the day when the X company's loss was determined. And whatever is the balance period, whether 2 or 3 or 4, at the time of merger, only the residuary period will be available. And again, this provision is applicable from April 2025. This was the big expectation in terms of simplification, rationalization, more from a perspective of getting some harmonious tax rates. We have 31 sections under the TDS under the chapter, and the rate ranges from 0.1 to 30%. But what they have adopted is instead of increasing the rate, they have essentially changed each of the section wherever there was a threshold, they have changed marginally the threshold. And let's say interest on security on debenture issued by company in which public are substantially interested, the current threshold is 5,000, they have made it 10,000, which means if I'm getting interest on the debenture and it is issued by a company which is public substantially interested, if I get up to 10,000 rupees, there will not be any TDS done by the company. But if it is beyond 10,000, there will be TDS. Similarly, for dividend for individual shareholder, the current rate for current level was 5,000. They have made it 10,000. Similarly, where the bank is paying or a cooperative society or post office on any interest on any such security, for senior citizen, they have doubled it from 50,000 to 1 lakh. For others, 40 to 50, and in other cases, 5 to 10. I will not read out the balance. I think the big change which they have done again with the motto of supporting and helping middle class is on the rental 194I, where the current limit of deduction of TDS under 194I used to be 2.4 lakh during a financial year, which they have made it to 6 lakh during the financial year, which is 50,000 rupees per month. This is a very big change in terms of limit they have done. The rest of them are basically a small change which they have done. In other words, they have not done anything to the rates, but I think they have adopted that by changing the threshold, they don't have to disturb the rate and other things. Still, you get the relief on that. Simplification or rationalization. This was always an ask that on a typical sale of goods transaction, there used to be both TDS and TCS. Again, of course, both the rates being 0.1 for any sale of goods exceeding 50 lakhs. So there were representations were made by the industries saying that on a same sale of good transaction, both are applicable. There is no need to have TCS So they have accepted it, and now they have removed the TCS, and it is now only the TDS of 0.1%. There was currently a provision that when you decide the rate on TDS and TCS, if the SSE is a non-filer, then the higher rate of tax will be applicable, both for when the directee or collectee is a non-filer of income. So the deductor has to first see that whether directee has filed the return, and if they have not filed the return, then you have to opt for the higher rate. Same is the case in the TCS. The collector has to see whether collectee has filed the return or not. I think this was creating a lot of issues for both deductor and collectors. So they have amended it, and both the TDS and TCS provision such situation has been omitted, which in other words means the deductor and the collector need not have to verify whether the directee and collectee have filed the return or not. They need not have to opt for the higher rate of TDS, and whatever is the applicable rates, they can go ahead and on that. The last one in this is they have last year, if you recall, they have introduced a new category of virtual digital assets, and their scope and the reporting obligations as to how they have to go about reporting and how they will be verified and all those things. There's a new scope of reporting obligations which have been mentioned in the proposals. Next, please. This is a somewhat to arrest the TP litigation. An option has been extended to the taxpayer, whereby suppose I am a taxpayer who I have international transaction, and before even my TP case is picked up, I go and opt before the transfer pricing officer that whatever you determine as an ALP for me, it may be what I have filed, or it may be more than that. I am ready to accept, and for the moment I opt for it, then the transfer pricing officer does the TP assessment for the year 1, and the same will be applicable for the next 2 succeeding years, which means all the 3 years in the block of 3 years, the same outcome and result will be there, subject to the condition that I opt for it. And after I get all the 3 years, can I challenge the election of opting? Answer is no. But can I challenge it in the appeal all the 3 years order? Because if the ALP as determined by the TPO is not acceptable to me, then certainly I can challenge. Last year also there was a mention in the budget that the safe harbor rules are going to be expanded, and the same thing was reiterated, and I expect that post budget they will be expanding the scope of the safe harbor rules so that much of the APS which are pending, probably the inventory will not spiral so heavily once these safe harbor rules for the new industries or new areas do come. Next. Updated tax return. Currently the time limit for filing updated return is 24 months, which has been extended to 48 months. And now the new timelines of filing updated returns and additional tax and interest payable is that within 12 months, if you file the updated return, you have to pay of the additional disclosed income tax and the interest 25%, 12 to 24, 50, 24 to 36, 60, 36 to 48. The key detailing in this provision is important to watch. That they say that if there are 2 provisions, 148A is when the show cause notice is issued to the SSE by the department to do the reassessment, and also the reassessment proceeding itself happens under 148. So it says that updated return cannot be furnished when the 148A notice, show cause notice is issued after 36 months, but before the end of the relevant assessment year. If the show cause notice is issued, then the SSE is forbidden to file the updated return. However, if there are notices 148A issued, but it gets dropped for lack of evidences or basis, then yes, up to 48 months, the taxpayer, because 148 is dropped, they can update their tax returns. These are the 2 sort of side provisos, which are very important to read it while seeing the new extended period of 48 months for updated returns. Okay. Sameer.
Yeah, thanks, Ganesh. We'll just pick up some speed and continue with the balance slides on direct tax. So this is very quickly on section 9A. This is more in the context of the safe harbor provisions for offshore fund and onshore manager. One of the asks of the industry was that the conditionality around the indirect participation of Indians in the fund being less than 5%, that be rationalized or be done away with. While that doesn't seem to have been considered, what they have really looked at is to say that because you need to compute whether participation is 5% and less than 5%, we will now prescribe 2 dates in a year when you're supposed to do that, which is April 1 and October 31, and some relaxation in case you're not able to do it on those 2 days. And the other point which has also been mentioned is that under the section, the central government is empowered to relax all the conditions that exist in the code. And one of the things which they have also done is that the condition which relates to participation of Indians, the relaxation for that, the central government permission seems to have been taken away. So we'll see how this pans out with the industry, but as of now, that ask has not been met. Moving to the next slide. Currently, if there is a banking unit in IFSC, which is giving access to non-residents by issuing an ODI, that payout, which happens under that ODI, is not subject to tax. It's only limited to ODIs being issued by banking units. This has now been extended to ODIs being issued by any other form of presence that may be there, FPI presence that is in the IFSC sector. So this was a very welcome move, which was a big ask from the industry. Relocation of funds, as you know, there is a tax neutrality if there is an offshore fund which wants to relocate into GIFT. That has now been extended to retail funds as well as exchange traded funds. Presently, there is a provision which gives benefits to aircraft leasing activities. This has now been extended to ship leasing units as well as in the context of treasury centers. The current provisions are one where deemed dividend provisions could apply to any treasury operation that is carried out. So what this section is now going to say is that if there is any loan or advance between group entities, they will not be subject to the deemed dividend provisions, provided the IFSC unit is one of the entities and the parent of that group is listed on a stock exchange outside India. So effectively, this is more in the context of inbound structures. In the context of insurance policies which are issued by IFSC units, currently, because of the way section 1010D reads and the manner in which the current framework is, they are still subject to the conditionalities where the exemption is not available if the premium exceeds the threshold limits. And this puts it at a disadvantage where an IFSC unit is issuing a dollar policy to a non-resident as against any insurance company issuing a policy from Dubai or Singapore or any other jurisdiction to that non-resident. So what this basically says is that the amounts received by a non-resident from an IFSC insurance office will not be subject to the premium conditionalities. And lastly, there was a whole number of sections where the commencement date for getting the benefits under the IFSC provisions was 31st March 25 or 26. This in one shot has now been extended all the way till 2030, which is a welcome step because earlier these were being extended in 1 year or 2 years kind of a time frame, but now they've done it straight away to 2030. So that's a very welcome move. Uday, you want to come in on the indirect tax?
Yeah, thanks, Sameer. We will start off with the GST proposals, and primarily, as is the case with every budget nowadays, the budget is an avenue to implement decisions taken in the GST Council. Okay, the recent council being the 55th GST Council. And So the first one that we've kind of put up here was the retrospective amendment has been introduced to deal with the judgment of the Supreme Court in the case of Safari Retreats Private Limited. I mean, this particular judgment obviously gained a lot of attention. Okay, the Supreme Court primarily interpreted Section 17(5)(d) of the CGST Act, which basically suggested that that the term plant or machinery, as referred to in 17(5)(d) hitherto, was not defined under the said section, and therefore, in a sense, allowed credit in relation to any plant or machinery that was any goods or services used for construction of plant or machinery for own use. The government, even while submitting in front of the Supreme Court, held that this was unintended, and by this particular amendment, retrospectively, have in a sense rectified or sought to rectify this particular ambiguity as per their kind of contention. So that amendment has been kind of made by way of an explanation being added to 17(5)(d) and the amendment in 17(5)(d) to that phrase plant and machinery, which has been amended to plant and machinery. So that was always expected after the 55th Council meeting. The second bit that again an amendment has happened is actually primarily to remove any ambiguity in relation to input service distributor mechanism, which is supposed to be implemented from 1st April 2025. What essentially has happened is that they've made minor amendments to both Section 261, the definition of ISD, as also Section 20 to allow the distribution of ITC on all reverse charge transactions, including the reverse charge transactions in relation to interstate or import import transactions. This was always the intention. They just kind of by this particular amendment removed the ambiguity. The next proposal, I think, is a very, very important proposal. It's going to impact all our lives fairly massively. The invoice management system was, in a sense, informally introduced and not mandatorily introduced by the GSTN on 1st of October 2024. This particular amendments that have been introduced via the finance bill, okay, is to allow implementation of the IMS. There have been amendments that have been done to Section 34(2), Section 39, and Section 38, and subsequently rules 61, 67, and perhaps are also going to be amended. Now, what is the government probably trying to kind of go ahead and put in place? One, in case everybody kind of understands what the invoice management system is, but let me just explain as to what the proposal is. That any amount, any supplier, when he uploads the invoice in GSTR1, that will create a draft, if I can call it GSTR2B. From the 14th to the 20th, the recipient or the taxpayer needs to give responses to every transactions reported in the draft 2B, if I can call it draft 2B. Okay, as accept, reject, or keeping it in pending. In case of whatever is accepted or whatever is rejected for that matters, will create a GSTR, final GSTR 2B, which in a sense is eventually proposed to be auto-populated in the GSTR 3B. Okay, and that's something that might come in the future. The critical element is that if a supplier is issued a credit note, and the reduction in liability will only happen provided the recipient accepts the credit note and reverses the credit. The recipient, in a sense, and if this recipient does not do so, supplier's reduction in liability doesn't occur. And therefore the liability, in a sense, continues. And if the credit note is, in a sense, rejected at a later date, at that point of time, the supplier might be required to, pay the tax, pay interest, if it is happening within a month. If he has not paid the applicable tax related to the credit note. The second bit is that in case the recipient does not keep the credit, respond to the credit note and does not accept, and then delays, let's say, rejection of the credit note at a later date, then the recipient, after a month, then the recipient has to probably pay interest. So that's the overall scheme that is being suggested. This will get implemented, and the amendments to this to the legislation has happened primarily to enable this. So this is a major change in the way your tax and finance processes would need to work, and everybody would need to take cognizance of that and get ready for it. It's a massive change. Okay, going to the next slide. They've proposed to introduce a track and trace mechanism for especially certain goods which they feel are more prone for evasion of taxes. Right now, they are looking at, in a sense, informally, if we could suggest, they're looking at products such as tobacco products. There would be this particular amendment has happened under Section 148A. That has been introduced to enable implementation of this overall mechanism. It means that every product will have a unique identification marking. That marking will include details of the date and place of manufacture, the machine used for the manufacture, production shift, and similar details related to the MRP, etc. So that particular provision to enable this has happened in Section 148A, and there is a penalty that is being proposed of 10% of the tax on or 2 lakhs, whichever is higher, for failure to comply. So that this particular provisions have been inserted, and we'll see this will get implemented from a date to be notified. The other amendments have happened primarily to reduce controversy in relation to time and vouchers, the taxability of vouchers. They've deleted provisions of Section 12, subsection 4, and Section 13, subsection 4. And now the vouchers will get, in a sense, taxed upon redemption. Also, provisions related to unredeemed vouchers have also been, would not be taxed, has also been kind of included. So again, this was a decision taken at the GST Council, which has been kind of enabled by these amendments. The next one is a major amendment that has happened, whereby earlier, or as on date, if I can call it, while filing appeal, the way Section 107, subsection 6, or Section 112 in relation to appeals to Commissioner Appeals or the tribunal, the pre-deposit is to be computed only on the tax of 20%, and there is an overall kind of limit of 20 or 40 crores in relation to the amount of pre-deposit that's required. Now the proposal is to impose a pre-deposit even where there is penalty to be applied, where there is no tax to be computed. We'll need to see whether the overall limit of pre-deposit of the 20 or 40 crores would also apply. This would apply when, as in when, on all appeals, primarily that would be filed after the amendment. So a lot of this is a major change, and it will impact several controversies. And the next one is a retrospective amendment to remove ambiguity related to taxability of on supply of goods which are warehoused in an SEZ or an FTWZ. They've kind of removed that ambiguity. The controversy was whether the applicability, whether this particular no supply applicability would be only for goods in customs bonded warehouse, not in FTWZ. So they have removed it by made it clear. So this is again a welcome change, and another one related to local and municipal fund. Going to the next slide, we will cover the customs proposals. The government initiated, rationalization of the tariff and the tariff structure for the last 3-4 years. This particular budget and the last budget, this has been moved further fairly rapidly. The simplification that has been proposed over the last year is to reduce total tariff rates from about 22, the way you see 22 to 25 to 8 tariff rates, including zero rate, over the last year. So that simplification has been carried out. The second simplification that has happened is right now there are several cesses that are applicable. These cesses are health cess, agricultural and infrastructure development cess, or social welfare surcharge, and of course the compensation cess that's applicable. What primarily is the intention is that among the health cess, agricultural and the social welfare surcharge, only one cess or surcharge would be applicable for a particular product. And that alignment is being proposed. And under that, social welfare surcharge on some 82 tariff line items has been exempted. There have been some amount of amendments to the basic customs duties have been reduced, and to some extent, it's been compensated by agricultural infrastructure and development cess. This allows the government to get central government to get a better share of these tariff items. So that's happened. There have been several amendments, like every year, on reduction in basic customs duty to incentivize local economic value addition on certain products which are critical for local manufacturers, critical minerals. And there have been certain increase in final products, duty rates on final products to 10 to 20% on textile products and electronic goods. Again, this has been a trend all this way. Some of these kind of amendments to the rates have been as per the planned manufacturing output that the government had suggested earlier for sectors, especially for electronic goods, battery, mobile phone. And so some of this was expected to happen. Some of the amendments have been also to mitigate controversies. Validity period of exemption for most products, actually all products except one, which were due to expire on 31st March 2025, have been extended for a further period, as has been notified under that notification. The next one is there is a proposal to kind of include a time limit for finalization of provisional assessment of 2 years to 1 and plus 1 year of extension. There has been by amendment an insertion of section 181C and 1B and 1C. This particular time limit can for pending cases can be extended in case of certain other kind of, conditions kind of are being applied. Another welcome change that has happened is the voluntary revision of import and export documents permitted for clearance. Right now, there was no such provision. People required to possibly even go through an appeal process for, amending a past bill of entry to happen. So this is a welcome change. And revised filing will significantly reduce the problems that were getting faced. There was another problem of availment of credit when payments were being made under TR6 challans. With this particular revision, some of that will get addressed. Settlement Commission is now going to be replaced by it's just a constitution in a sense that is changed. And there have been certain relaxations that have been introduced, welcome ones, on import of goods at a concession rate of duty rules. So the time limit for fulfilling end use has been increased from 6 months to 1 year, and return filing frequency has been changed from monthly to quarterly. So again, a welcome change. I've tried to cover the important kind of amendments. Over to you, Sameer. Thanks for time.
Thank you. Thanks, Uday. Thank you for that. Very comprehensive. So let's get started. Amar, if I can bring you in. Of course, there have been a lot of announcements, on manufacturing, on nuclear energy, center of excellence from an AI point of view. So when you look at it as a large conglomerate group, how do you see some of the specific announcements that have come through? And how do you see, how does that impact, the GDP and the growth of the economy going forward?
Sure. So what I will say is, let me start first with just saying thematically, this is consistent with what we have been hearing for a while, right? So whether I look at starting with fiscal prudence or the focus on structural reforms or what the focus on new age tech and making India a manufacturing hub for the world, many of these are aimed at those same themes. And so at least the consistency it has been pretty phenomenal in my view. So I think as a group, I really welcome that ability to have predictability in what the government is doing. I really think the ease of doing business measures will help us in the long run. Although, I want to see those play out. Some of it is supposed to come through a 1-year committee which will look into things, etc. The trust first slogan that the finance minister talked about, to me, that's music to the ears of any corporate, right? Because as you are all well aware, there's a lot of litigation, there's a lot of time being spent on what can be avoided. So I think that will be good to see that come out over the course of the next few months. Tariff rationalization should be very helpful for us. And then I think one thing that the finance minister has been trying very hard is move some of the burden of capital expenditure to private enterprise, right?
Right.
And I think she's doing everything possible to make it easy for all of us to contribute towards nation building. And I think I see that as something that private enterprise should be doing more of. We as a group have already announced a lot of investment into capital expenditure. And I think we just need to continue to do that because the government, because of what you heard earlier today, also has some realities of balancing the budget, etc., that it has to manage. So I think that's great as well. The last thing I will say, Sameer, is this consumption-led inclusive growth model that the government is trying to build, where by putting more hands with the middle class families, more money in the hands of the middle class families, that in turn leading to more MSME kind of industrial demand, which is being supported by policies which help MSMEs. I think that's going to have, again, a lot of positive momentum across the board. So I really like that as well. And of course, the focus on agriculture. So as a group, because we play in 70% of the sectors where India is going to see growth over the next 5 to 10 years, all of these measures will be very, very helpful and very positively seen by the group. As I mentioned, the one that I want to watch is structural reform and the ease of doing business and the trust first when it comes to taxes, because I think that will truly ease. I think I mentioned to you when we chatted, I had an opportunity to meet with the FM, and this was one of, as an industry delegation, we had talked about ease of doing business. So the two areas we talked about, she has acted on. At least the words are there, and I think we just need to see the actual action supplement that, right? So those would be my thoughts.
No, absolutely. And when she was speaking, I was going back to our conversation on both these items, right? And I said, okay, that's 2 out of 2 things that we spoke about specifically in this area. And just one more thing before I come to the other panelists on some of the more specific questions. Clearly from a ease of doing business, tax law simplification is a big item, right? And she's obviously given an idea that we will be tabling something very soon in the coming week itself, right? And when it comes to looking at litigation and pending litigation, right? Are you looking for a lot of items to come in that direction as well? Because one is just simplification of law from a go forward point of view, and the other is going to the backyards and seeing what needs to happen.
Yeah, I think, Sameer, you are an expert on this. So I haven't seen yet the government do something which will retrospectively change things that are in litigation. The VVS schemes are in some way, that's how you settle these, which is in some ways good. We've just been debating things from pre-GST for so long that I think it's good to clean that up. But I think the fact that there will be 50%, at least that's what she stated, 50% less words would mean 50% less interpretation issues, right? And I think that itself should lead to less litigation. So I really welcome that. I think that will be huge, because I think words is what creates most of the disconnect between the corporate sector and the tax authorities, right? And
I like your correlation. I like your correlation and optimism of the 50% reduction. So
I would really hope for, yes, I think that would show true ease of doing business, right?
No, I agree with you. And I think that's, putting your money where your mouth is, right? Absolutely.
Yes.
Absolutely. So thanks for that, Amar. I really appreciate, all your comments. I'm just going to go quickly to Ganesh and Uday for a couple of minutes. And I know we are running out of time. Ganesh, one very quick question which has come from the audience, which is on this new section around EMS. Then the question is, what type of income streams are encompassed under this section?
What type of income? Any kinds of income. That's why I clarified that all other deemed profit scenario under oil and gas. Typically, they say that if the income character is of royalty, FTS or P, those will get out of it. But here they have not carved out anything, which essentially means regardless of the character of the income, you will be deemed whatever payment is being made of that 25% as profit.
So I think that's a pretty significant step, because effectively the tax rate will be less than 10%.
Yeah, 9.8.
Yeah, 9.8% to support the EMS industry. I think that's a very positive step. And the other question is, this is around from somebody from the pharmaceutical industry, from what I understand, is with respect to the removal of TCS. And, in your mind, is that a very significant move, given the amount of compliance that exists on the whole TCS sale of good provisions?
Yes, because I think this was an ask of the industry over the last 2 years, that on the same transactions, both TDS and TCS being applicable. And I think this used to not only create a lot of compliance burden, but also same transaction getting taxed both from deduction and collection point. So I think that's really a welcome thing.
Great, thank you for that. Uday, one question for you, which is really around the retrospective change introduced post the Safari retreat ruling, and how would this impact the industry at large?
When it was the largest controversy, which kind of went on for a long time. the government made their intention fairly clear that the interpretation given by the Supreme Court eventually was not the intention of the government, and it was almost like a clerical error in the difference between 17.5D and 17.5C, and therefore the intention was not to kind of grant credit. And that's what they've kind of implemented just to remove that particular ambiguity from a retrospective amendment. To my mind, and they had announced it earlier. To my mind, there are still avenues that and observations by the Supreme Court, which I think some of the people will still try to kind of see in specific circumstances to avail the credit. But this controversy, by and large, has been sought to be kind of stopped or mitigated by the government by this amendment. I think the major issue for us is to actually look for the future and engage with the government, especially for allowing specific credit, especially for, let's say, critical construction such as data centers, maybe even malls for that matter, and engage with the government to allow credit specifically for some of these in general.
So it's a lot to do with how do you genuinely address it, block credits in all of the large capital expansion areas, like you rightly called out. Okay.
Yeah.
Okay, so I think we'll have just time for one more question. And again, Uday, this is more on IMS. This is around, the impact that businesses will have and how should they start preparing for that?
So, I mean, the impact is fairly significant. There are two big changes that are happening. One is happening in the from April 2025, which is the implementation of the ISD. And again, that is a major change in the way people account for the credit and distribute the credit everywhere. And again, the reason why I call that out is because that requires a transaction level for all inward transactions, a response as to whether it should go into the ISD or not. So that I think is one. The second is IMS is so ominous, primarily because every inward transaction will require to be seen from the 14th to the 20th, in a sense, or kept pending for some time, for the acceptance or rejections or some response has to be given for it, for these particular kind of transactions. Thereafter, if you don't do it, there is an impact on your outward liability. If you don't address it, if you even don't consume the responses given by the customer, there are impact on your outward liability. As a customer, if you don't respond for credit notes in the given time, there is a direct impact of interest on the customer also. So through the ecosystem, everybody needs to be, in a sense, aligned and come to some amount of conclusion on every invoice. And that I think is a very, very large requirement. And all of that, earlier, similar things were being proposed, but there was a larger time that was given to taxpayers to deal with it in the earlier schemes and which were abandoned. This one, the proposal is to mandate everybody to do it within a particular monthly life cycle of filing of returns. So a major change, and I think people.
So it can be effectively a pretty large drain on working capital if you do not do the right thing within the prescribed timeline.
And also a direct cost of interest, Sameer, in case.
Correct. In addition to that, yes.
Yeah.
Great. I think we are
Sameer, one question.
Session. Yeah.
One second I'll take. There is a question that on the TDS on rental. Yes. The trigger of TDS under the new recalibrated base is per month, not per annum. So it is 50,000 per month. So although it translates into 6 lakhs per annum. So if an individual pays even for 1 month, let's say 65,000 rupees as rent, still they are subject to TDS.
Correct. So it doesn't subsume in the overall annual limit.
Yeah, correct.
All right. Thank you. Thanks for that, Ganesh. So we are at the end of our session, and I will just close by saying that obviously a lot has still come in, though this was within 6 months of the last budget. And the way ahead is really to look at what comes in the new direct tax bill that will be introduced. And hopefully, like Amar said, it will be simple language that will at least bring down litigation by 50%. So thank you for joining, friends, and it's a real pleasure to have hosted you all. And hopefully you found the discussions insightful and useful. Thank you very much and look forward to seeing you again.
Thank you.
Thanks.